tax revolts are as old as, well, taxes, it seems. It's possible that tax revolts played a part in the downfall of many Egyptian empires, as well as the Roman and Aztec empires, among others. There are people who claim that those who protest paying taxes are uncivilized, but really, who doesn't want their taxes lowered? Even people who don't pay taxes. We all want to pay less, and we all want someone else to pay more. So, who should pay more, and by what measure? There are a lot of different claims about what we should base our taxes on, from various flat tax proposals to a value-added tax to several wealth tax proposals to, well, the list goes on and on. But here's the thing. Everybody claims that their system is fair, but everyone's definition of fairness is different, and frankly, almost nobody's definition goes straight to the heart of what taxes are for, which is the essential ingredient. Understanding what taxes are for, using that understanding to define what would be a fair tax system, and then figuring out how to implement such a system. This three-step process is what we'll be looking at in this episode of Progressive Solutions. So, what are taxes for? What is the purpose of taxation? That's actually a very easy question to answer. Taxes pay for the cost of government. Okay. We all know that. The problem is, what should government cost? And before we can decide that, we have to agree on the purpose of government. What is it for? I believe there is a definition for the purpose of government that spans the political spectrum. But to find it, however, we need to go into a little history of human society. From the earliest hominins millions of years ago up until the beginning of farming less than 15,000 years ago, there were a lot of different human species. But even in the most recent parts of prehistory, we know very little about how societies were organized. It appears, however, that even the largest groups were no more than a few dozen people. But we really don't know anything about their social structure. Was there a leader or leaders or even some sort of hierarchy? Who made the decisions on where to live and when to leave? We just don't know how they governed themselves. Beginning with the agricultural revolution, however, the size of human societies began to grow. People could settle in one region over a long period of time, and the relative abundance of food, well, that allowed for larger groups of people to live in that one region. And government, as we know it, became not only possible, but necessary. As societies grew too large for everyone to know everyone else, they needed to create systems so that they could function fairly smoothly as a society. This included the creation of formalized laws and of methods of enforcing them. Inevitably, some people rose to positions of rulership. They were the governors, and the systems they created and enforced were the early forms of government. And taxes were levied to pay for what government did. And so that the governors could acquire life's necessities, food, shelter, clothing, and probably some luxuries as well. Probably. Lots of different systems evolved. Many succeeded, and many others failed. In general, however, the governments that succeeded were the ones that allowed the society not only to take care of its members' basic needs, but also to create things that made life easier and more luxurious, what we call wealth. And that brings us to the essential purpose of government, to provide the infrastructure that allows members of society to create, accumulate, and maintain wealth. Notice that this definition doesn't require any particular form of government. A benevolent dictatorship might theoretically fulfill the purpose as easily as a pure democracy. Even where most people agree on a form of government, there's still plenty of room for debate over the extent of governmental powers, and as societies are imperfect and problems are constantly changing, that debate will never end. But the basic definition stands through all the debate. If a government makes it easier to create wealth, it succeeds. Otherwise, it fails. We've now answered question 1. The purpose of government is to make creation and accumulation of wealth possible. Now on to question 2. Who should pay for it? The fairest way to decide who should pay is to figure out who benefits and match payment to benefit. The more you get, the more you pay. If the purpose of government is to allow creation and accumulation of wealth, then it seems pretty obvious that those with the most wealth benefit the most, so they should pay the most. Yeah, this is the easy one to answer. The final question, though, is how do we accomplish this? And right away, there are two problems. First problem is how wealthy is a person? How much wealth do you have? Try adding it up. How much is your toothbrush worth? What about any shirts in your closet? Are they worth less because they're in your hamper? How much is your car worth? Or what about the couch that the cat is using as a scratching post? How about the computer that you're probably using to watch this video? If an ordinary person can't figure out their wealth, what about the millionaires and billionaires? Most of their wealth is tied up in intangibles with no fixed value, like stocks and bonds. In fact, the values there are constantly changing. Determining how much wealth anyone has is hard enough, but it gets even harder when we consider possible definitions of wealth. Let's go back to your toothbrush. Does owning a toothbrush add to your wealth, or do we consider that a necessity? What if you have a spare toothbrush, or how about an electric toothbrush? How many dinner plates or bed sheets or shirts should be exempted from the wealth count because they are necessities? Do you own your house? If so, how much of its value should be counted as necessity and how much is wealth? If homeowners get to exempt some of the value of their homes, what about renters? What do they get to exempt? Do you have a credit card with debt on it? How about student loans or car loans or a mortgage? Hey, some people have negative wealth. That is, they owe more money than they have. Should they get a tax credit? What if most of your wealth is tied up in your home and then you'd need to sell your home just to pay your taxes? It all boggles the mind. If we can't even figure out how much wealth people have, then how can we possibly determine a tax rate? And how can we tax necessities, and what exactly would qualify as a necessity? The second problem, at least here in the U.S., is constitutional. Article 1, Section 9, Clause 4 states, "No capitation or other direct tax shall be laid unless in proportion to the census or enumeration hereinbefore directed to be taken." It turns out that a tax on wealth is considered a direct tax, and yes, income tax is a direct tax too, but the 16th Amendment took care of that. So if creating a wealth tax is such a pain in the neck, probably be struck down by the courts, what can we do? The first thing we need to do is to understand that most current attempts to determine how fair a tax system is only compare taxes paid to income earned, and the problem is that wealth rises far faster than income. For instance, say a family is making a combined $40,000 a year. They probably aren't seeing much, if any, increase in wealth. In fact, they could be going deeper into debt. Double that income to $80,000 and the wealth starts to increase. Double it again to $160,000, that family's certainly putting away a decent amount of money. Wealth rises a lot faster than income. The second problem is that most attempts to explain the so-called tax burden, well, they leave out a lot of taxes. Comparing people's federal taxes alone generally concentrates entirely on income taxes and ignores Social Security and Medicare taxes, federal gasoline and other excise taxes, such as taxes on alcohol and tobacco, gift taxes, estate taxes, etc. And for state and local taxes, well, don't get me started. Okay, get me started. Here's a partial list of potential state and local taxes. The next thing to understand is that while the federal government probably can't tax wealth directly, states can. In fact, a property tax is a direct tax on wealth, and most states tax real estate at least. In addition, some states tax what is known as tangible personal property. It includes things like furniture, clothing, vehicles, machinery, things that can be touched. Then there's intangible property, such as stocks and bonds. Intangible property generally isn't taxed. Only the profits from selling that property is taxed, and usually at a lower rate than earned income. Put it all together, and we've got the potential for a tax system that more closely taxes people based on their wealth. The key is to figure out how much of that wealth, based on several levels of wealth, is tied up in various forms of tangible and intangible property. For example, the value of a homeowner's house and property usually doesn't go up as fast as the homeowner's wealth. A person worth, say, $50,000 may have a house that's valued at $300,000, but someone whose wealth is more like $10 million, 20 times as much, their house might only be worth a couple of $1,000,000. If a real estate tax was assessed on a progressive scale, one rate for the first $200,000 in value, then a higher rate for the next $300,000, etc., Just like income taxes are theoretically assessed, well, that would more closely tax the actual wealth of the homeowner. Taxing tangible property is a little bit harder. I mean, how do you add up all the stuff that qualifies as tangible personal property? One way would be to put a simple threshold below which no tax is paid. Most people could just sign a simple statement that their tangible personal property falls below that threshold. Those with extensive personal property, like a lot of expensive jewelry or an antique car collection, lots of art, well, they would be the only ones taxed. Finally, states could tax intangible personal property every year, based on the value of the stocks owned at the end of trading on the last day of the year. This valuation, known as mark-to-market, is easy to do and easy to assess taxes on. Add it up and pay a flat rate. This would be a tax that's very close to taxing wealth directly. Of course, any profits from stock sales, even if the stock is sold to avoid the intangible property tax, would still go into the taxable income category. Now that all works for state and local taxes, which is a good thing because state and local taxes tend to be more unfair than federal taxes. But what about the federal level? If we can't tax wealth directly, we can at least tax other things in a progressive system that essentially balances taxes with wealth. Of course, the complex part there is all the loopholes that wealthy people get to use and find all over the place. Family foundations, for example, are a prime way that wealthy people avoid paying taxes. Trusts, offshore accounts, and many other loopholes and deductions need to be closed as well. But even before we start closing loopholes, there's a giant step that we need to take. Right now, unearned income, such as dividends and capital gains and a lot of variations, they're actually taxed at a lower rate than earned income. And since wealthy people tend to gain more wealth through unearned income, there's something seriously wrong with this system. If we taxed unearned income at the same rate as we tax earned income, along with a progressive rate system and closing loopholes, we'd get a lot closer to what amounts to a flat tax on wealth. In other words, a fair tax system. And this is only about personal taxes. We haven't even touched business taxes. Sounds like a topic for another video. Gotta jot that one down. As always, I welcome your comments. Do you have any other ideas on making a fairer tax system? What loopholes would you close? Let me know in the comments below. Meanwhile, if you like what you see, hit that subscribe button and also knock that thumbs up button as well. Thanks for watching. Stay progressive.